Welcome to Certified Credit's Talk Data to Me podcast, where our FCRA certified experts help you tackle the latest regulations, emerging trends, and unique challenges of the mortgage industry with an intuitive, people-first approach. And of course, data. Because your business is built on more than just a score. Visit certifiedcredit.com for more information. Certified Credit helps you hone your best practices from lead generation to post-closing QC and everything in between.
This is Elizabeth Lang-Barton of Certified Credit's Talk Data to Me podcast, and joining me today is the lovely KP. Hey, KP, how are you?
Good. Thanks for having me here all the way from Corona, California.
Love it. This is my favorite. And also joining us today is Paul Robinson of Certified Credit. So, gentlemen, we're here to talk about the current market. It's almost the new year. We're counting down. I have my little calendar, and every day I'm going, all right, one more day, making that to-do list for next year. And so some of the things I wanted to talk about with both of you, being experts in our industry, is what will 2023 look like? We had a wild ride this month, the past couple of years. And so let's just start with Kevin. Let's do like a quick summary of 2022. What was your experience in 2022?
Well, I can tell you that the volatility is still with us. It's not quite over. I mean, speaking of calendars, we had to get 3 extra Advent calendars because my 4 kids were fighting over who would peel off the day. So so there's a lot of volatility at home for me as well. But 2022 is really a tale of two halves, right? So the first half of the year was actually pretty good. Rates, we started the year with historically low, literally the lowest rates ever. We're still in 22. I believe even maybe as late as February, certainly January, but we had some low rates, which kind of fueled the spring purchase season. And then obviously the tightening cycle started happening with the Fed in March. And we saw rates just kind of tick up and up. And, we're a very interest rate sensitive industry. And so second half of the year has been a brutal drawdown. And there's just, it's part of the cycle. And it was a very hard slamming of the brakes this time around because, I've seen several cycles since 01. This one is obviously unique to itself because of the inflation fight that we're having. And so, look, next year is already shaping up to be a good year. And so I think, this year isn't over yet. And there's a lot of actions we can take as you check off your calendar every day. There's a lot of things we can do to get prepared for the spring purchase season. It's a normal purchase market, right? We're back to a normal seasonal market where people kind of go into hiding around Thanksgiving and they come out of the woodworks after New Year's and start looking for houses. The colder areas, maybe that gets extended a little longer, that house hunt, than maybe the warmer areas. Of course, it depends on how mild of a winter we have. But interest rates certainly are a big driver. And so what we're noticing right now at the end of the year is that people are still looking for homes. They're still looking. They're watching online. They're seeing what's going on. They're getting pre-qualified with originators. We got about 1,000 originators in our retail channel. We serve, let's call it 6,000 in our TPO channels, both wholesale and correspondent. And all of them are telling us that it's getting busier with pre-quals. So borrowers are trying to get ready to go into next year and then pull the trigger. So what are the things they're looking at to pull the trigger? It's like shopping, right? You're looking for a deal. Are the prices going to come down? Are the rates going to come down? One or the other, or maybe some people who are more conservative are waiting for both, or maybe they're just, their lease isn't up yet, or they're waiting for a seasonal time, which really like the fundings really pick up, as spring purchase season comes into play. So we're ending the year on a high note, and we've seen the light at the end of the tunnel. You've seen some data reads out there with inflation coming down and the Fed making some statements out there. We've seen interest rates improve. So I'm standing by our call here. We've seen peak rates and peak inflation, and that's a good sign. It can only get better from here as we move into 2023.
Yeah, I would agree. I think a lot of what we saw in this early part of the year really had a lot of people in high spirits and high hopes. And then we really hit that break. And it's been a challenge. We've seen our coworkers laid off. We've seen our friends in the industry let go. We've seen a lot of turbulence, and it really makes us think like, oh, what is 2023 going to be like? And so it's good to hear, our industry experts like you saying, yeah, you know what, it's been tough, but we're going to forge ahead. And I think looking at the credit side, Paul, we've gotten a number of updates that are coming in 2023 that do kind of throw some wrenches into that. So, Paul, from the vendor side of the equation, what does 2022 into 2023 look like?
Right. Well, I mean, with 2022, it's kind of ending not as happy as a lot of credit vendors would like to see. It's a cycle. We were kind of talking about that before. We're all used to it every year. January 1st is coming around. December, all the credit companies get together, try to find out, what's our increase from the credit bureaus going to be this year, or from our third-party vendors that we resell as well. And typically it's nickel and dimes in the past.
Mm-hmm.
But, it still hits the bottom line of our customers, which are, loans are already, you're not making a ton of money on them in the first place. The last thing you want to do is hear from your credit company that we're increasing your fees or passing on fees. This year, it's been one of those exceptions where not only are we passing on a huge increase, but it's the largest increase since I think we went to the 3 bureau model there.
Wow.
So that's we had a wonderful early 2022 as well. We saw that again the volume slow down, and we know that some of our customers are really hurting out there. The last things we want to do is to deliver bad news. So unfortunately, through December, we're kind of getting with our customers, let them know what's going on with the price increase and how big it is, but, working with them on a solution. It doesn't have to be all bad. Maybe some of our customers do need to change a little bit to their process and procedures on, how they're ordering credit, at what point they're ordering credit, what type of credit report are they ordering in the cycle there, and really getting, the biggest bang for their buck, or maybe passing on fees where they haven't in the past as well, where they took it on as a cost of doing business. It's really having a conversation at the same time as, delivering not the greatest news they want to see in, December 1st of the year, but getting folks prepared. So, I mean, that's kind of how our 2022 is ending. 2023, though, there's still a little bit of unknowns with the FHFA's director coming out at the MBA saying, hey, they're going to the Vantage score and a FICO score model rates and the introduction of 4 credit scores. Man, I've been doing mortgage credit for 23 years. I can't figure out in my mind how they're going to pick which score to go off of the 4 scores. There, we're going with the top one, the low one, second to highest, second to lowest. But again, that still may not even happen in 2023 because there was such an unknown left off of that.
You said something really interesting in there, Paul, and I kind of want to throw this back over to Kevin. You had said about you're not making much money on a loan. And that's why your credit partners, your vendors, your technology partners are trying to help you find cost savings where they can. And Kevin, you talked about, I think it was last week. So as of this recording, it's December 6th. So you talked about this the first week of December, and you said lenders are not making money on origination. So one of the things you started talking about was how lenders are offsetting those lack of revenue from loan origination with other servicing. So, kind of what are you seeing in that space when it comes to offsetting during this lean time?
Yeah, I mean, well, just to clarify that and put a bow on that is that, it's the origination part that is lacking profit, right? So a company can still be profitable, but the loan level margin is just not there. And part of it's just a function of the Fed and the higher interest rates. We buy and sell money, and that's what our business is predicated on. And so when you're talking about selling mortgage-backed securities, why would someone, ultimately, whoever it is, want to buy a loan at 7% when they're pretty certain that in like 90 days, they could refinance at 5.5%? Or maybe it's 6 months. Okay. So maybe, let's use some conservative estimates, but I think everyone generally agrees in 2023, rates are going to be down, and all the forecasts out there, even the most conservative forecasts by economists and whatnot, have rates in the high 5s by the end of next year. Now, a servicer takes on that money and that loan to service it long term. I mean, you make like 25 basis points a year minus your servicing costs. Let's call it 4, 5, 6, 7, 8 basis points to service that loan. So, you're going to pay all this money to then have it refinance and go away. And so what's been happening is these rates at these loans, these higher rates, they're just not worth as much to the end buyers. So that's what margin compression is. There's just less margin in the deal. And then there's less deals, right?
Yeah.
And we had a record May. May was the biggest May we've ever had as a company.
Wow.
We funded $1.35 billion in May. Now that's not our biggest month we've ever had. We've had some big months. $1.75 billion, I think, is our biggest month, in the past, in 21. But to go in May at that number and everything's going great, and the whole system and capacity and the model we built across 3 channels, serving originators in all these states, and all of a sudden for it to shrink down literally in 90 days. I mean,
Right.
go June, July, August was tough. I mean, I would say November was a little worse than August. And December should be a little better. Then January, February, not so great, but then we start to ease up going into the new year. So the point is that you either are living off your past profits, or if you're fortunate enough like us to be a servicer with Fannie Mae, Freddie Mac, and Ginnie Mae, issuer with Ginnie Mae, have a portfolio that has a servicing strip that is paying money every month to help subsidize the fact that you're investing or paying or losing money, however you want to spend it and say it, on your day-to-day origination operation. And not every company has that. And everyone has a servicing portfolio to fall back on, or a strategy. Maybe there's an owner there, it could be an individual, it could be a hedge fund or a bank. And they're like, sorry, we didn't sign up for this business to lose money. And so that's why you see these closures, especially in the wholesale channel. I mean, there's no money in wholesale. It's absolutely negative margin for sure. And so, you're basically seeing closures. You're seeing larger companies go out of business, because some owners don't have the appetite to lose a penny, and they're not seeing the forest through the trees, right? They're saying, we're good. We did good in 2021, even the first half of 22. We're going to mail it in. And that's fine. I mean, we're here for the long haul. So, the other way, of course, is to look at our costs and, make sure that we can save money where we can. And, Paul brings up some great points. I mean, here at the time of the industry, it's really the lowest point it's been since 2008, and the credit collapse and the Great Recession, that now FICO is raising the prices on the industry. So, then you're put in a bad position, your company, because you have to pass along. You have to go to as someone that is a great facilitator and an agency, a credit partner to a lender like us. You're having getting costs passed to you. You have to turn on pass to us. You don't want to be the bad person,
right?
But I think the industry is starting to get some visibility around that. There's a lot of people shining the spotlight on where that cost is being originated. The CFPB is now involved. The FHFA is now involved. And so, because ultimately borrowers end up paying that cost, right?
Yeah.
And so, good. I mean, it's about time someone else faces some regulatory heat. We face it every day, right? So, as a lender, so I got my popcorn ready. You gonna raise the price on us? All right, let's see what the regulators say to you. That's how I'm looking at it. Not you in general, but where it's coming from. So it'll all come out in the wash. We know that.
Yeah, I think that's one of the nice things. There's been a lot of transparency this year. I think we've had a lot of really good conversations as an industry about, what does it like? We had issues in the spring about HMDA data, and there was a lot of transparency about that. Now that we're having these price increases and these other compliance issues come up, there's a lot of transparency industry wide. We're having a lot more conversation. And so it's really interesting because in there, you were talking about diversifying. And you're talking about like how you guys you're being very transparent, and you're talking about how you guys are diversifying. You have these actions set in motion. But if, let's say, someone's not already in that servicing game, and they're not probably going to be able to be in that servicing game, maybe they're a smaller broker, they're a smaller lender. So what are some other ways that they can kind of like look at those cost savings? And I'm kind of tossing this to both of you because I think you both have a unique perspective on this.
Again, it kind of goes back to being, be able to pivot to a different process or procedure than past. When it comes to, dealing with vendors there, forever everybody was implementing, automation. That caught up with a lot of folks really quick, where they'd order a certain product as soon as an application was ordered out of a POS. They were just spending money hand over fist and just going with it because they wanted that. They worked on that automated piece probably for 2 years, and it finally got implemented, maybe at not the right time. Kind of drawing that back, working with them with going on different milestones of ordering a product within the transaction than they're used to. But everybody has to be on board. We can go in and consult a customer till we're blue in the face, but if they don't implement it and then follow up to ensure that their implementations are being followed by their staff, it doesn't work. But I think, of course, probably the 100 conversations I've had in the last 2 weeks now, or longer, because we were very proactive when it came to, these increases and what's coming down the road. Though we couldn't give exact numbers till they came out, we were just kind of getting everybody ready. But it's these conversations we're having. When are you ordering this? When are you ordering that? Why are you ordering this? When? And we're asking a heck of a lot more questions as a credit provider than we've ever had before in the process. In the past, we're probably like, who are you using? How much you paying? All right, can we beat that or not? Now okay, well, you don't use this, and this product with us. Have you thought about bundling that into, into a back end fee? If the loan closes, then you're only charged for this instead of paying upfront when the application's taken. It's becoming the consultative, I guess, sales approach more. We preach that all the time, even with our reps. But this year, we really have to be that consultant and friend, and more than, it kind of goes to our tagline. We're more than that company that you're just paying a check to at the end of the month, for your credit reports.
Yeah, so I agree. You guys have been a great partner in that. We went through, our proposal together, and one of the things that we were talking about was doing soft pulls of credit. And you talk about, changing your processes, within the walls of a lender, for example, as it relates to credit. What's interesting is, there's a little chicken or the egg here thing with the whole, FICO price increase, right? I will now be contrarian and put on my FICO hat. Here's this company out of Montana that a regulator is saying, instead of my algorithm of FICO being on 3 credit reports on every single deal, now it's only going to be on 2. And that means that third bureau, whoever's on the out on any, what was a tri-merge, which is now a bi-merge, is now going to be competing. So the idea is that now my algorithm is only on 2 reports, and potentially those 2 reports. So right off the bat, you're cutting third, right? Your revenue. And then because there's now competing entities amongst the 3 to get everyone's bi-merge business, the concept, just kind of talking out loud here, is that the price of those FICO algorithms on the remaining bi-merge then, of course, themselves would be less. So, that's called margin compression. So when we face margin compression, we didn't go out and raise our prices. So, so this is what I hate about what they did. So you can tell I took my FICO hat off, right? So
threw it on the floor. It's gone.
I threw it on the floor and I spit on it, right? But I understand, right? And so what they really did, though, this is the thing, the chicken or the egg comment, is that they just forced everyone to go to a soft pull now. So to Paul's point, it was easy when money was flying hand over fist just to pull a tri-merge every single time, see if someone's credit's any good. But now, which, by the way, that causes a trigger lead. And so now FICO has, also kind of wrecked the trigger lead business a little bit, because they're going to force lenders to get their systems in place to do soft pulls of credit upfront, which, thank God, we've been working on it for over a year, as you guys know, in our conversations with y'all. So we have been pulling soft pulls and working them into our pre-qualification. We're getting our originators, and look, there's a higher bar of compliance, getting borrowers authorization for a soft pull of credit. And so getting our systems in place and being very strict with our originators. You can't just pull soft pull on everyone. You have to get like legit bar authorization and record it. And there's like this whole process. It's not as easy as it is with the tri-merge, we've worked for many months on this system to get it in place. So, I think FICO kind of cut off their nose to spite their face, because now they're going to force everyone just to go to soft pools, which are significantly cheaper than a tri-merge. And so, they just force the industry's hand. And I think it's going to backfire, honestly. And we'll see what happens. It'll come out. So it's way bigger than KP talking data to you.
Well, you were talking about in there with the difference between that, what's required for that tri-bureau pool and what's required for that that pre-qualification. Yeah, I'm over here jumbling words, but that pre-qualification. And the one thing that I think you were alluding to, but you didn't mention in there, is that customer experience. And like, in order for it to be a pre-qualification, there has to be a customer experience, and it has to be consumer driven. Unlike your, pre-approval or that, initial credit pull. Because when you do that, that's lender driven. And so that kind of leads us to, when we're looking at all these changes coming, how is this going to impact the end consumer? Because at the end of the day, all this isn't just going to impact the lender. It's going to change the consumer behavior. It's going to change consumer confidence. So, going back to the beginning of our conversation, how do we see this current market impacting consumer behavior and confidence, and these changes that have been made in the past month or so to impact that consumer confidence and behavior?
Well, that's a great question. And let me tell you, the originator still holds the most weight in shaping that consumer experience. So we have a saying at PRMG, we say built by originators for originators. We serve all originators. I have to be like Switzerland, right? And just be neutral. I don't care what channel an originator's in, right? I think they're all great. And, so we have a wholesale, a correspondent, and a retail channel. And they each have their pros and cons in serving an originator. And so in that vein, it doesn't matter what channel they're in. The originator is the one teaching financial literacy at scale. And I'm going to say that till the day I die. When you need a loan and you're a borrower and you're a first-time home buyer, where do you get your information from? You can go to my KP Talks Dollars and Cents videos on YouTube all you want. You can go to my rambling 10-minute videos on LinkedIn, not that consumers are there. You could go look at whoever's out there. But at the end of the day, where the rubber meets the road, and once you're ready to talk about getting a loan and getting a house and getting a mortgage, you're always talking to an originator. And almost always, more often than not, you're talking to an originator first. They're the ones being your trusted advisor, your debt manager, your finance, your financial friend. It's the originator that really shapes that. And so I'm in a lot of these, like Housing Renaissance and Mortgage Collaborative, and I go to these meetings and these think tanks and this and that and the other. And, it's funny, you've got people that set policy, right? And they're in DC, or maybe they're, in the boardroom in New York at some large institution. And I don't think they're so far removed enough to know what I'm saying, but I still remind them all the time. It is the originator that teaches financial literacy. And so that's who shapes the experience. And so, that's who we put on the pedestal first and foremost. Now, to do the soft pull and move it through the process.
And that consumer experience is so important, especially as we are in this digital age. Because if you think about where we're at now, your first-time home buyers are primarily going to be digital natives. And so they expect that level of, you are doing things in a way that's succinct, that's streamlined, that things are connected, because that's the world that they grew up in. And so it's really interesting when you're talking, because you're talking about that consumer experience is that platform. It's how they communicate with their originator. It's how they communicate with, when I went through, buying a home, we even communicated with our title company through a digital platform. So everything was brought into this digital hub. And so whether it's, your blend, or it's a simple nexus, or it's any kind of POS system, it's going to create that customer experience that people are expecting to be there, because we
love Simple Nexus too, just so you know. We have some users on it. I love their team. They're great people over there. I love going and working with them. So there are multiple options. Those are our top two for sure.
Yeah, but I think they all, if you're talking about it from the general sense, they all create a different customer experience. and kind of guide people through the process. So if you're an originator, that's one way of shaping your customer experience. And I really like that you hit on the education part there, because so many conversations that we've been involved with have revolved around consumer education. It's fundamental, especially right now when you might not be making that sale. You can at least be educating home buyers on the way to, or borrowers or prospective borrowers on the path to home ownership. Because at the end of the day, no matter where we're at, I've said it a million times, and everybody in our industry has, we're trying to get people in homes. And so our job, no matter what level we're at, whether you're the originator or you're a vendor, or, you are just working for a mortgage company, or you're at a title company or PMI, you're educating borrowers on what that process is like, because there's this inherent distrust. There is, Kristen Meserly has been touting this since her first, home buyer report, but there is this distrust in our industry because it seems so convoluted. Just think about if you told a consumer that, oh, you're now going to have to get 4 different scores, in the next 18 months or so to, submit it to a secondary mortgage market, which also could be part of mortgage-backed security, like going into all the lingo and the language that we use, it's not consumer friendly.
But you still bought a house.
Exactly.
Oh yeah, but I still have a house, and they still have a house, and
this is what's great about this conversation is like you're the quintessential millennial, right? Yeah. Like obviously you're in the industry, so you're a little, a lot more knowledgeable than your average first time home buyer.
When I bought the house, I was not in the mortgage industry.
Right.
And it was scary. It was scary. I was like, I am giving you $17,000 for a down payment, and then I'm giving you more money for this and that. And by the end of it, I'm like, I am handing over almost $40,000. What? Why? This is like the biggest purchase of your life. That first initial home is like, all of my savings are going into this 4-walled structure. Maybe some others have more, but I have 4 walls. But like it's scary. And like it is, when you're that first time home buyer, you need that person who's going to hold your hand. And like I was very fortunate that my realtor was also very knowledgeable. And she had people who she trusted, and she had me meet with different lenders and say, these are some of the people I recommend. Talk to them and see what you think. And I went with the person who held my hand, who gave me cost sheets, who went and said, okay, if you do this, this is your option. Here are some other ways you could modify the cost. Here are some things that I would stay away from. Hey, could you do this % more because it's going to lower your PMI by this much? Like she walked me through all of my options and like spent hours on the phone with me, talking to me about like, okay, you're going to sign this piece of paper and this is what it means. And like, it really shaped my experience. So I think no matter what the market is, and I took us totally off track here, but no matter what the market is, this is so important, is that like education piece.
You have no idea how, like you could just take the last 3 minutes of you talking and just have its own little clip. And I hope originators see this video and say, do you want to know what your client is thinking? This is it. This is literally it, because you had that experience before you were in the business. Now you're in the business, so you can really verbalize what you were thinking at that time. And you are the first time homebuyer. You are the quintessential millennial that goes through the process. You just shared all the things. And I love Kristen Meserly's playbook. When she puts it out, every year, and she puts out in November. It was amazing reading through all that. This is what our clients are thinking. And so again, we're teaching financial literacy to you and to first-time homebuyers at scale. And it is the mortgage originator that's doing it. And so whether it's a realtor that you kind of, use their trust and relationships to, let you have some options to talk about, and then you got to choose for some, good for you for actually shopping, because most people only talk to one originator. They don't really shop around because it's a lengthy conversation. You could talk for easily an hour.
Oh, if not more. Yeah.
Right. And let's be honest, like millennials don't want to have that same conversation for an hour with 3 different people. Man, I already heard this from someone else. It's starting to sound the same.
Yeah.
Right. So what is it that differentiates, that first, that second? I mean, most people don't even talk to two realtors or two originators. It's like 90% only talk to one or two of first-time home buyers. So this conversation is being had all the time at scale, and the tools that we give, the points of sale, like the blends, or the experience that you give, it does matter, and it does help us, cut through time and provide more value to you. And I think, again, with lower rates coming, and we've already seen them come down, we're going to have even more of these conversations going into next year. And this last little segment is like the playbook for an originator. This is what you need to be good at.
Yeah, well, and I think that all ties into relationships. Like, we're talking about this education piece, but as we move into 2023, 2024 and beyond, relationships are critical. I can't tell you how many conversations I've had this week alone, and it's only Tuesday, about why we need to build relationships with not only people inside our industry, but also with our consumer. Because when we're talking about, before our call, Paul and I were talking about the underserved communities, and we're doing a webinar on the 15th. This will come out on the 13th. And then on the 15th, we're doing a webinar with Convergence Memphis, iEmergent, the American Homeowners Council, and talking about what does underserved communities look like, and where is that opportunity to build a relationship, to educate, and then eventually turn that into a potentially, profitable relationship where you are able to get people into homes and you're able to get them mortgage ready. But it ties back to, we have to build those relationships, because if, originator ABC came up to me on the street and was like, hey, I want to write a mortgage for you, I'd be like, I don't have a relationship with you. So I relied on my relationship with my realtor. Or I don't have a relationship with you, I'm going to go to someone who I know, or someone that has reached out to me and provided a resource and has said, let me just talk you through the process.
Or maybe your, reputation management is so important. Maybe you're reading, the experience.com, surveys online, about this particular individual. When you're out looking around for someone to know, like, and trust, you can leverage that trust from other people who have had that experience, and that's why reputation management is so important. We do that on behalf of all of our originators here and the company, because people look at that stuff, even the dreaded Yelp that I can't stand. It's such a monopoly, but anyway.
Yeah, no, it makes sense.
I kid to my Yelp friends. I love you guys, but you bury the good.
Be coming after Kevin.
Yeah, they bury the good ones and they elevate the bad ones and they make me pay them more money. It's like I'm on you, Yelp. But all kidding aside, they're good people over there. We do business with them.
Well, I think that's the perfect way for us to kind of segment, like, what can you do in 2023 that's going to set you apart, no matter whether, many experts at one point were saying we're going to expect 8.5 to 8.25, percent mortgage rates across the board. Will we see them? Will we not? We don't have a crystal ball to say, yeah, we will. Yeah, we won't. Will we see the 5% ish that, you talked about earlier? We don't know. But what's the one thing you can do to move forward is focus on education, focus on relationships. And with that, gentlemen, do you have what is your one tip, one takeaway, one thing that someone should be focused on in 2023 and beyond?
We've been working really hard here to help people compress time and reduce friction and scale their business. And so that's kind of a sexy way to say time management, be more efficient, that kind of thing. But we're leveraging technology to help us reduce time and friction, compress time, get more done, so we can be more relationship driven, right? So I think there's a way to leverage technology to allow the human interaction and the human part of being a local originator or a local realtor and providing that value for first-time home buyers like you. And so if I can find ways to be in front of you more often, or to show that I know what I'm talking about, to use and leverage social media or landing pages, maybe do a little advertising, some video marketing, highlight some experiences, do some reputation management, all this stuff, and then bring someone into a conversation, in a frictionless manner, having them use a nice point of sale customer experience, guide them through the process, make them feel at ease, because it is the largest purchase we make. So we're working on all these different ways just to make it an overall better experience for our originator, because the originator knows best how to have a better experience for the consumer. And so we've been putting all of our time and effort into our originators, and it's translating into better consumer experiences. So that's what we're working on. I could go through a laundry list of partners that we've worked with to help try and make that a reality, but we're just getting better every day, and we think next year is going to be a very good year.
Wow. How am I supposed to top that with my puppies thing here, Allie? So,
well, you were supposed to go first, so I can go last and drop the mic.
I guess if we're going in company direction, I think, Allie, you and I probably hear this the most from ownership, and our gracious leader, Lucy, is I think we're really going to focus on solutions this year for everybody. It's going to be solutions-driven 2023 for us, and that's whether finding solutions to process, procedures, pricing, and structures, anything we can do to help continue the great relationships with our customers moving forward.
I will tell you, in our conversations, you guys have done that. Just coming up with all these solutions. Let's work on this thing here. Let's work on, this credit solution, or, this transcript solution. Let's work on all these different things. You guys have been a really good partner in that respect. And so I will tell you that, we keep chipping away at those solution-based conversations, and, something's going to hit. And I'm telling you, like, that is the way to go. I mean, every lender is, we're all going through it right now. We're evaluating all of our existing relationships and contracts and costs, and, doing what we can to be able to overall, ultimately come up with solutions that benefit, the end consumer at the end of the day, and our originators, of course. So yeah, thank you for being solution-based.
You got it.
And thank you for joining us today. I think this was a really good conversation, and we always really appreciate talking with you, Kevin. I think you offer a very unique outlook on the industry, and you offer a very unique, I won't say personality, but like, that's it. Like, you have an infectious energy that I think whenever you talk, people want to listen. And so, like, it has been wonderful being able to engage with you and learn from you. And so, we appreciate you so much. And Paul, thank you as well for joining.
Thank you for the kind words. I appreciate it. I wish my 4 kids, 9 and under, felt the same way when Daddy talks.
That's right.
I have to raise my voice. I have to raise my voice and take a screen away or a toy away or something. That's the only way they listen to me. Like, imagine kids, they're young, being into sales. Like, they are so stubborn. No one's deterring them. They're going to take on the world. But I appreciate the kind words. If you think people listen to me, it sure doesn't feel that way at home.
Well, we listen to you, Kevin. So you got 2 in your corner.
All right.
All right. Well, thank you, gentlemen, so much. And I wish you both a happy holidays and a prosperous new year.
Cheers.
Same
Cheers. Have a good one, guys.
Cheers, guys.
Thanks for listening to Certified Credit's Talk Data to Me podcast. With over 35 years of industry experience, Certified Credit is your multifaceted mortgage solutions partner. Learn how our commitment to passionate service, innovative products, and superior technology create a more profitable and efficient lending environment for our clients at certifiedcredit.com. Certified Credit, more than just a score.